I'm going to talk to you on the topic, beating the benchmark, is it everything? We all know that benchmarks are here to stay. Every product in the financial market is linked to a benchmark, its performance is measured. Often we see that the performance of a fund manager or an advisor is linked solely to his outperformance of the benchmark. Over time, we have come to believe that beating the benchmark is everything. In this process, it has become a kind of a winner takes it all game where everybody only looks at beating the benchmark. Over shorter spans of time, this will work. But in the long run, there are some factors which are far more important than beating the benchmark over a shorter span of time. In every bull market, we have seen that the benchmarks have got skewed. But let me walk you back to the last two bull markets and remind you what happened in this benchmark beating game. In 2008, somebody who was overweight infra would have beaten the benchmark. Somebody who was consciously underweight infra because that sector had balance sheets which would come apart and it did not merit taking too much risk to the extent of the benchmark. The risks far outweighed the merit of the returns, and therefore the prospect of near-term returns was probably alluring, but it made sense to walk away from such risks. Those who walked away from those risks in 2007 would have outperformed the benchmark, while those who embraced those risks merely to beat the benchmark would have been rock stars. Now let's go back to 2000. There were at least two fund managers who were extremely overweight on tech stocks, and some of the companies they went overweight on were not at the same level as the leaders in that industry. Also, they bought these leaders also at valuations which did not merit investments. Interestingly, within 3 or 4 years, these rockstar fund managers were not regarded the same way as they were in 2000. Investors who blindly believed that outperformance of the benchmarks in 2000 was going to be a long-term trend were proved to be awfully wrong. History repeated itself in 2008 as well, where the fund managers who relied heavily on infra did not do well for several years after that, and their funds went on to being managed by other people or languished. Now, if you are an investor who went by the outperformance over the benchmark in those extremely frothy market phases, you would have faced a testing phase after the bull market was over. You will not know what the future holds for you when you only look at the benchmark. You need to understand the risk-taking strategy of the manager. You need to understand how he is walking you through this journey. If you are on a vehicle that's doing a journey of 500 kilometers and you find that one vehicle is moving faster than the other, if you blindly hop onto that vehicle, it does not mean that you will have a safe journey. It may not even mean that you will reach the destination, whereas the vehicle which looks like it's doing the journey at a slower pace may probably have a better certainty of reaching you to that destination. Investment journeys are very similar, and benchmarks are like your speed indicators. They are not necessarily a pointer to the success of your journey. So that in essence is what you need to remember while you are obsessed about beating benchmarks. Managing the risks is always going to be a superior responsibility and a higher need for you and your investment manager, And unless you are going to focus on how your investment manager can sustainably do this, merely looking at benchmark and buying a product can definitely not give you the best of experiences, especially when a bull market is ending. Thank you for watching this video. I would request you to share this video with your friends who are keen investors.